Let's stay on the markets here. Bring in Tim Hayes. He is the Chief Global Investment Strategist at Ned Davis Research. Tim, always good to see you. We're seeing the market trying to rally a bit here, but nonetheless still in the red. What do you make of the action?
Well, I think we've had after this strong rally, it really left the market quite stretched from a valuation standpoint, sentiment excessively optimistic, and really vulnerable to the bad news we've been hearing regarding the coronavirus second wave over the last couple of days, and raising new doubts about whether, in fact, this economic recovery is actually going to happen that the market's already priced in. So clearly, I think the momentum has started to turn negative here, and the question is really how bad it's going to get, or are we going to start to stabilize? And we don't really know the answer yet.
Tim, this morning, Trump's advisor, Larry Kudlow, said during an interview that he still believes a V-shaped recovery is possible. He believes that unemployment will be below 10% by the end of this year. Is the White House a little too optimistic, you think, about this economic recovery?
Well, clearly, I mean, that's the best case scenario. And in this environment, there's so much uncertainty. And this is we've never had a situation like this before. I think we need to really be open to, a variety of outcomes, both that positive outcome, but also a very negative outcome. And that's how we're positioned right now. And being at market weight equities, we're ready to turn more overweight. If our indicators start telling us actually we're getting the signs that actually the economy is broadening out globally, or in fact, we're going into another big decline and perhaps going back toward the lows. So yeah, I would say it probably is a sign of really pricing in the best case scenario.
Tim, what triggers you to get too underweight on stocks?
What I would be watching for is we've had a lot of our shorter term indicators based on market breadth, based on participation, which have, as I said, have really gotten better on the idea that the economy is going to come back. But if those favorable indicators reverse course and we start to see the momentum pick up on the downside, and we don't see improvement in our fundamental indicators based on economic performance, our model will start to deteriorate. We'll respond to that, and we'll get back to underweight. And things are moving very quickly this year, and so we want to be very responsive once we start to see that happen.
Tim, Ines Ferre here. On the flip side of that, what would be a reason for the markets to go higher from here? Is it another stimulus package, extended unemployment?
Well, that really is the big question here from a longer term standpoint. Is all this stimulus that's already been provided, will it in fact have the normal impact that it's had? For example, after 2008, 2009 decline, are we going to see economic activity really pick up quickly? And that's far too soon to say that. And the potential bearish scenario is we don't see all that stimulus have the intended impact, and the market just, the economy stagnates and the market starts to anticipate an extended stagnation period. And you just go through these phases of rallies and corrections and rallies and corrections. You don't really make any headway over the long term. But we really have to see things broaden out beyond the staples and the healthcare stocks, of course, benefit in this environment, the tech stocks. We need to see signs that actually industrial activity is going to pick up globally. And it's far too soon to get to that point. That would also need to be followed by retail activity, consumer and business confidence broadening out globally. Far from that point at this stage.
Tim, are you seeing signs that it's safe to jump back into some of these markets that were hurt because of the pandemic? I'm thinking of Europe. I mean, we're seeing all of these new cases now in the U.S. Things don't seem as bad over in Europe. What do you think about their stock markets right now?
Well, they have started to show stability on a relative strength basis, but it's still the same thing. This has to become global to the extent that we're going to see travel pick up globally. And even within Europe, we have big differences between the different countries and to the extent to which they opened up and the extent to which they're allowing travel to take place, business activity to pick up. So I'd say the same thing about Europe. Too soon. We have started to see some signs of relative strength in emerging markets. And in the Asia area, but that's also far too soon to say it's ready to make any kind of a aggressive commitment to equities at this stage.
Tim, I can't seem to make sense of this yet, and I suspect a lot of investors can't either. What's worse for the stock market here in terms of political risk? 4 years of Joe Biden or 4 more years of chaos under President Trump?
Well, we might want to think about this from both a short-term and a long-term standpoint. One of the interesting tendencies of the market, and we have a chart showing this, is that when an incumbent Republican loses the election, there's actually a pretty decisive period of underperformance in the second half of the year. And it could be that's what we're going to see here from now into the election. But once we're past that point, there's really no consistent tendency, and we could actually see the market do well once the negative aspects, or what the market thinks are negative aspects of a Biden election, would be priced in. Then the market could start to rally if, in fact, these other fundamentals I've been talking about, the economy coming back, the response to liquidity, become more evident. Then that will drive the market higher on earnings expectations picking up. But I see it really political tendencies. They tend to be more short-term, influences, and that could, I think, right now we could already be seeing some of that influence weighing on the market.
Do you think this market has priced in a Biden win yet? And also, we didn't even talk about the Senate. If the Senate were to move Democratic, has this market considered that and baked it in already?
Well, I mean, I think one thing is that since the polls have changed so dramatically, so quickly, and this happening at a time when the market's gotten very overvalued, and as I said earlier, our sentiment indicators show excessive optimism, clearly we haven't priced in the other scenario. And so I'd say the answer is no, it has not been priced in. It's probably going to weigh on the market. So, I think it's consistent with a lot of other things we're looking at right now.
Tim, is it fair to say, just for investors who are out there trading a little more aggressively, as long as Biden is leading this much in the polls, this market can't go any higher?
Again, I don't think it's all about Biden. It's all about the election. I mean, it's really going to have to be. I mean, the coronavirus is far more influential, and the impact that's going to have on the economy opening up, that I think will be a more important factor. But like I said, you put all this together, and we use sort of a weight of the evidence approach, and we look at all these influences, and right now they're all lining up, in a pretty threatening way towards equities. So I think we're going to have to see some solid signs of things like the PMI data starting to pick up both in the U.S. and globally, retail sales picking up, signs of confidence, and that's going to require us to get past these various waves of the coronavirus that keep showing up, and it's going to be hard to see confidence, both business and consumer confidence, really coming back until we're at a broader recognition that this virus is under control, and that may require waiting until we get a vaccine, and who knows when that's going to happen. So this period of uncertainty and kind of these short-term rallies and corrections could be the environment we'll be in for quite some time.
So what do you tell investors who may be watching all of this, anxious to jump in, sitting on some cash right now? Is it best to wait things out because there is so much uncertainty, or is there some valuations that are just too attractive to pass up?
Well, I look at things from an asset allocation standpoint, and the major point really that we've been making since the beginning of last year was put your money in bonds and put your money in gold, and just avoid the stock market, because there is so much uncertainty and things are so short term. And unless you're an extremely effective, nimble trader, you're going to run a lot of risks that you're going to get on the wrong side of a trade. So bonds, have been a place to be. From we remain overweight bonds as we're market weight equities, waiting to see which way things break. We've been bullish on gold since the beginning of last year. Gold's making new highs. Gold benefits from dropping interest rates, especially real interest rates that are falling. Also, in this uncertain environment, gold benefits from its store of value characteristics, and also as a currency alternative. When you have this accommodative environment, everybody wants their currency to weaken to help stimulate, but you can't have everybody weaken their currencies at the same time. Gold tends to benefit in that environment. So those would be the places I'd look for right now. And once we get out of this, and we get the better valuations in the stock market, then I'd say there could be some very good opportunities. But I'd say it's too soon to really recommend anything in equities from really from taking an aggressive point of view.
All right, let's leave it there. Tim Hayes. Yep. Tim Hayes, Chief Global Investment Strategist at Ned Davis Research. Always good to see you.
Thank you. Great to be here.
Hey investors, Zach Guzman here. Are you interested in learning more about the markets and getting the latest financial news? Well, then click right here to subscribe to our Yahoo Finance YouTube channel. Get the latest up-to-the-minute market analysis, big interviews in the world of finance, and information on how to manage your money every day wherever you are.